Every generation of investors believes their crash is different. The one happening right now, whatever it is when you're watching this, feels unprecedented. It feels like this time the system might actually break. Like maybe it won't come back. Like maybe the rules have changed and the old playbook no longer applies. Every generation has felt exactly this way. And every generation has been wrong. Not because crashes aren't real, they are. They're brutal. They destroy wealth, end careers, wipe out savings, and leave genuine human damage in their wake. I'm not going to minimize that. But the historical record, 150 years of it, tells a story that most people in the middle of a crash cannot see. A story of panic, collapse, recovery, and growth, over and over and over again. Understanding that story is one of the most valuable things you can do as an investor, because the investor who has studied the history of crashes doesn't panic the same way. They can't. They know too much. So today, we're going to walk through every major American market crash of the modern era. What caused each one, how bad it got, how long recovery took, and what the pattern tells us about the next one, whatever and whenever that turns out to be. Let's start at the beginning. October 1929, the crash that defined a generation and gave the word crash its modern financial meaning. The 1920s had been extraordinary. The Roaring '20s were exactly that, roaring. The economy was booming. New technologies, automobiles, radio, telephones, were transforming American life, and the stock market reflected that optimism, rising six-fold from 1921 to 1929. Six-fold in 8 years. But underneath the boom was a dangerous foundation. Millions of Americans were buying stocks on margin, borrowing up to 90% of a stock's value to buy it. Investment trusts were piling leverage on top of leverage, and valuations had long since detached from any reasonable measure of corporate earnings. By September 1929, a prominent economist named Irving Fisher proclaimed that stock prices had reached, and I quote, "what looks like a permanently high plateau." He said this roughly 6 weeks before the collapse. Economists have been getting this wrong ever since. October 24th, Black Thursday. Panic selling began. Bankers pooled their resources and bought large blocks of blue-chip stocks publicly, trying to restore confidence. It worked briefly. Then came Black Monday, October 28th. The Dow fell nearly 13% in a single day. And Black Tuesday, October 29th. 16 million shares traded, $14 billion of value erased in one session. But here is what most people don't know. That wasn't even the worst of it. The market kept falling for nearly 3 more years. By July 1932, almost 3 years after the initial crash, the Dow had lost 89% of its peak value. 89%. A dollar invested at the 1929 peak was worth 11 cents. Not because of one bad day, because of 3 years of relentless decline, bank failures, unemployment reaching 25%, and a complete loss of confidence in the financial system. The Dow didn't return to its 1929 high until November 1954, 25 years later. And yet, the American economy survived. New institutions were built: the SEC, the FDIC, deposit insurance, securities regulation. The Glass-Steagall Act separated commercial and investment banking. The system was rebuilt, stronger than before. And the investors who held through the devastation, or who bought during it, eventually saw extraordinary returns. The lesson of 1929 is not the market always comes back quickly. It doesn't always. Sometimes it takes a very long time. The lesson is that it does come back, and the investors who understood that, who prepared for the long wait, survived and eventually thrived. Now let's talk about a crash that was almost the mirror image of 1929 in one crucial way. October 19, 1987, Black Monday, the single worst day in stock market history, measured by percentage decline in a single session. From August 1982 to August 1987, the Dow had risen from 776 to 2,722, a stunning bull run. Markets around the world had risen nearly 300% over that period. Investor confidence was extreme. A new financial instrument called portfolio insurance, essentially a computerized hedging strategy, had become widespread on Wall Street. And then, on one Monday morning in October, everything broke at once. The Dow fell 22.6% in a single day. Not 22.6% over a year, not over a month, in one trading session. The S&P 500 fell 20.4% the same day. Circuit breakers didn't exist yet. The market just fell freely all day. By the close, over $500 billion in market value had evaporated. The cause was largely mechanical rather than fundamental. The portfolio insurance programs, designed to protect against losses by automatically selling as the market fell, created a feedback loop. As prices dropped, the algorithms sold. As the algorithms sold, prices dropped further. More selling triggered more selling. Human panic layered on top of machine panic. It was the first algorithmically amplified crash in history. It would not be the last. But here's what makes 1987 so instructive. The economy barely flinched. GDP kept growing. Unemployment stayed low. No banks failed. No recession followed. And the market, which had fallen 22.6% in a single day, finished the year 1987 with a small gain. A small gain for the full year, despite the worst single-day collapse in history. Within 2 years, the market had completely recovered every point it had lost on Black Monday. The lesson of 1987? Not every market crash reflects an economic catastrophe. Sometimes the market breaks for mechanical reasons, and when the underlying economy is healthy, the recovery can be surprisingly fast. Now, the dot-com crash. March 2000 through October 2002. And this one is important to understand fully because it's often misremembered. The 1990s were a decade of genuine technological transformation. The internet was real. Email was real. E-commerce was real. The productivity gains from technology were real. What wasn't real were the valuations attached to companies that had no revenues, no profits, and sometimes no actual product, just a business plan and a website ending in .com. The Nasdaq Composite, heavy with technology stocks, rose from roughly 1,000 in 1995 to over 5,000 in March 2000, a five-fold increase in 5 years. At the peak, some companies were valued at hundreds of times their revenues, not earnings, revenues. Many had no earnings at all. When the bubble burst, it burst completely. The Nasdaq fell 78% from peak to trough. 78%. Not in 33 days like 2020. Over 30 months. Slowly, relentlessly. Many individual tech stocks fell 90, 95, 99%. Some to zero. And unlike 1987, The broader economy did feel this one. A mild recession followed. Trillions of dollars in paper wealth were destroyed. Tens of thousands of tech workers were laid off. The venture capital market essentially froze. But something important happened inside the wreckage. The real technology companies, the ones with genuine business models and durable competitive advantages, survived. Amazon, which fell from $107 to $5.51 at the trough, a 94% decline, survived. Apple survived. Microsoft survived. And in the decade that followed, those companies became some of the most valuable enterprises in human history. The lesson of 2000: not all companies survive a crash. The index does. Individual stocks don't always. Diversification is not just a strategy. During a crash, it's the difference between recovering and not recovering. And then 2008, the one that nearly broke everything. I say that without hyperbole. Senior officials at the Federal Reserve and the Treasury have since disclosed that in September and October of 2008, they genuinely believed the global financial system was within days of complete collapse. Not a severe recession, complete collapse. ATMs potentially shutting down, banks unable to process transactions. The cause was a decade in the making. Easy credit. Subprime mortgages issued to borrowers who couldn't afford them. Those mortgages packaged into securities and sold globally. Those securities rated AAA by rating agencies that didn't understand what they were rating. And leverage, extraordinary leverage, layered on top at every level of the financial system. When home prices stopped rising, when the foundational assumption of the entire structure turned out to be wrong, it all unwound simultaneously. Bear Stearns, Lehman Brothers, AIG, Washington Mutual, Fannie Mae, Freddie Mac, Merrill Lynch. In the span of a few months, institutions that had stood for decades collapsed or required emergency government rescue. The S&P 500 peaked in October 2007 and fell for 17 months, ultimately losing more than 55% of its value. The housing market collapsed. Unemployment reached 10%. 8 million Americans lost their jobs. And yet, the Federal Reserve, under Ben Bernanke, a scholar who had spent his career studying the Great Depression, acted aggressively. Interest rates were cut to zero. Trillions in emergency liquidity were injected into the financial system. The government passed the $700 billion TARP program. The auto industry was rescued. And slowly, painfully, the system stabilized. The S&P 500 bottomed in March 2009 and then gained 70% in the following 12 months. The economy began growing again in mid-2009, and the decade that followed, 2009 to 2019, became the longest bull market in American history. The investors who sold in October 2008, who couldn't bear to hold through the worst of it, locked in their losses and missed one of the greatest recoveries in market history. The investors who stayed, or better yet, kept buying, were rewarded beyond what anyone predicted in the dark days of 2008. The lesson of 2008. Sometimes the system really is in danger of breaking. Government intervention matters. Having emergency savings matters. But patient investors who hold diversified portfolios through even the worst crises have, historically, been vindicated. And finally, 2020. The fastest crash in history and the fastest recovery in history. February 19, 2020. The S&P 500 hits an all-time high. COVID-19 is spreading globally, but hasn't yet been declared a pandemic. Within 33 trading days, barely 6 weeks, the market has lost 34% of its value, the fastest decline from peak to bear market in history. Circuit breakers triggered 4 times in 10 days. The Dow fell nearly 3,000 points in a single session on March 16th, the largest single-day point drop in history at the time. Unemployment applications hit 6.6 million in a single week, a number that had never been approached in American history. Then the Fed acted. Interest rates to zero. $1,500 billion injected into money markets. Congress passed a $2.2 trillion stimulus package. The Fed announced it would buy corporate bonds, something it had never done before. April 2020 became one of the best months for the stock market in over 80 years. The S&P 500 was back above its pre-crash high by August, just 5 months after the crash. By the end of 2020, it was up 18% for the full year. The fastest crash in history, followed by the fastest recovery in history. Because the cause was external, a pandemic, not a fundamental breakdown in the financial system, and because policy response was faster and larger than anything attempted before. The investors who panic sold in March 2020 missed the entire recovery. Some of them sold on a Monday and watched the market begin its recovery that same week. Now, let's step back from the individual crashes and look at the pattern, because there is a pattern, and understanding it changes everything. On average, a bear market, a decline of 20% or more, happens every 3.5 to 5 years. A major crash of 40% or more tends to happen roughly once a decade. That means over a 40-year investing career, you will likely live through 8 to 12 bear markets and 3 or 4 major crashes. This is not a risk you might face. It is a certainty you will face. But here is the other side of that certainty. Every single one of those crashes, 1929, 1987, 2000, 2008, 2020, was eventually recovered from. The market is higher today than it was before any of those crashes, significantly higher. The investors who survived, who stayed diversified, who didn't sell into the panic, not only recovered, but ended up wealthier than before. There's a concept I want you to hold on to. It's called sequence of returns risk, and it matters most for investors who are close to retirement. If you are 30 years from retirement and the market crashes 50%, you have time to recover. If you are 3 years from retirement and the market crashes 50%, that's a different and more serious problem. Your investment strategy should account for where you are in your journey. The closer you are to needing your money, the more defensive your portfolio should be. The further away, the more aggressively you can own growth assets and ride out the volatility. But for the long-term investor, the one with a decade or more of runway, history offers a consistent message. Every crash has been survivable. Every recovery has happened. The only investors who permanently lost money in market crashes are the ones who sold during them. Let me close with the 3 things every investor should do before the next crash arrives. Not during it, before. Wealth Move 1. Know your number before the crash hits. Before the next downturn arrives, ask yourself, if my portfolio dropped 40 or 50% tomorrow, would I be forced to sell? Could I pay my bills? Could I keep my house? If the answer is no, if a crash would force your hand, then you are carrying more risk than you can actually afford. Reduce it now while markets are calm, not in a panic later. Wealth Move 2. Build your recession buy list now. Every major crash in history has created generational buying opportunities. Amazon at $5, the S&P 500 at its March 2009 low. The investors who bought during those moments, not at the exact bottom because nobody catches the exact bottom, but who bought somewhere in the depth of the panic, captured extraordinary long-term returns. Write down now, if the market drops 30%, what will I buy? Which index funds? Which specific companies, if any? At what price points? Have the plan ready before the panic arrives, because in the panic, you will not be able to think clearly. Wealth Move 3. Maintain emergency cash outside your investment portfolio. One of the primary reasons investors sell during crashes is not because they want to, it's because they need to. An unexpected expense, a job loss, a medical bill. Suddenly, they need money, and the only place to get it is their investment account, which is down 40%. 6 to 12 months of living expenses in cash outside the market is not dead money. It is insurance against being forced to sell at the worst possible time. It is what keeps your investment thesis intact when everything feels like it's falling apart. Every crash feels like the end. That's not a weakness, it's human psychology. The same instinct that kept our ancestors alive, flee from danger, tells us to sell when markets fall. But markets are not predators, and the response that protects you from predators will, over and over in market history, cost you your retirement. The investors who have built the most wealth in modern history are not the ones who predicted crashes. Nobody consistently predicts crashes. They are the ones who prepared for them, who held through them, who sometimes bought through them, and who understood in their bones that the history of the American economy is a history of surviving catastrophe and emerging stronger. Preparing without predicting. Always. And if this kind of deep, historical, honest financial education is what you've been looking for, subscribe to Trek for Wealth. We go where the headlines don't. We tell the whole story, and we give you the frameworks that last a lifetime. Your trail map for building, growing, and protecting long-term wealth. Trek for Wealth. Keep trekking.